There we go. All right, perfect. So welcome, guys. If you guys do not know already, my name is Zach, co-founder of the group. The other man speaking, his name is Spencer, my co-founder of iTrendz Trading as well. We have somewhere in the vicinity of this live as well, we have a couple analysts and a moderator, analyst Jack and Nick, and also Desi, and then a wonderful professor with us who helps us with all of our projects and products, specifically this one, Christina. So shout out Christina, she's awesome. She's also been in the group for honestly pretty much since day one. So big shout out to Christina. Anyway, a little bit about iTrendz Trading. We formed about a year ago. We have a Discord group. I'm sure you've seen Discord groups around. We're just another community out here trying to inspire the youth and people of all ages to get into stock trading and how to make money in the stock market, whether you're trying to make it your side hustle or your main gig. We're here to help you out with that. So as you can tell, today we're going to have a day. We're on day one, but we have 3 days worth of classes. Day one is very basic. We're going to go into the basics of what is a market, what is market structure. We're going to go a little bit over the cash and like the different accounts that you need, et cetera, et cetera. Day two, we'll go in a little bit further into how to understand options, a lot further into charting and how to identify certain things on a chart like supply and demand zones, et cetera. And then the third day, Spencer and I will be going in depth on our own trading strategies, how we actually look at trades, how we identify the zones that we're trading, how we then enter and exit the positions. So we'll be going very much so in depth on the third day there. These will all be recorded. Day one will be uploaded on our YouTube, available to everybody. Day two will be uploaded on our YouTube, available to everybody. Day three will only be on our private YouTube, just to keep our strategies safe. With that being said, we will also on day three have some goodies for people. We're going to be giving away some ebooks for free. We have a couple ebooks. We have one that's already out. Well, we have multiple that's already out. We have one on patterns and indicators. We'll be giving that out to quite a few people for free. And then we also have one coming up which is just based on candlesticks and price action. And that will be free for you guys as well. When we drop it, we'll just make sure to get your emails and make sure to send you that when it's all finished. Should be finished here in the next couple of weeks. Just doing some finishing touches. And then also we'll be giving away another goodie, a good discount code to our community as well, for anybody that wants to join. So if you stick around to the day three, you'll be blessed with those. We do have to get this out of the way. Disclaimer, we are not financial advisors. This is just for educational purposes. So with that said, getting that out of the way, one thing that we're going to be going over here in the beginning is just basically, again, the basics, going over risk management, going over how to actually how to actually use your broker, when you're looking at the market, what actually is controlling that? What does it mean when you see a red candle? What does it mean when you see a green candle, et cetera, et cetera. And with that being said, I will pass it on to Spencer.
What's going on, y'all? This is Spencer, aka the Stale Ham Sandwich. I'm not a financial advisor. I'm just here to help you guys. So let's get this started. First, we're going to start off with supply and demand. This is what governs the market. In simple terms, all the markets use supply and demand. We use supply and demand mainly to draw support and resistance lines when we're trading options or stocks. But this is what's actually going to move the price up and down. When the demand is higher than the supply, the price moves up, and vice versa. When the supply exceeds demand, the price goes down. And this is something we focus on. So this is what's controlling each candle and controlling our options, whether they're going up and down. So in the stock market terms, when there's more sellers, when there's more supply, the price is moving down. When the buyers step in, that's where it's going up. And this is a really key factor when going on the market, and we're going to keep moving. So we're going to break down the difference between stocks and indices. This is something really important because, like we were talking QQQ is going to be a index, and stocks are just simply a single share of a company. But the benefits with stocks, it allows you to get dividends, and any price action moving towards the upside, you capitalize that as a single stock investor. So that's just one single company. Now, an indice or an index like QQQ or SPY is a basket. It's a group that's together. Now, usually institutions, they will use indices to hedge their positions to protect a single sector. Like you'll see QQQ is heavily in the technical sector. And normally most of these ETFs, they stay in the same industry that they're at. But overall, the index is a bet on the overall sector, whether it's going to move up or down. And then on a single stock bet is just what a regular stock is. Now we'll go over the best time to trade. So trading times in the stock market, you have 4 a.m. to 9:30. That's what's considered pre-market. That's where institutions will trade shares, and you'll see the price moving, and normally it's lower volume. Now, when we get to 9:30 to 4, that's when the option market opens up, and that's when the actual stock exchange opens. From 9:30 to 4, trading options or stocks, just depending on their pleasure. Now, after hours is going to run from 4 to 8, and that's what we call after hours. Normally, you'll see low volume. You'll see some institutions step in around 6:30, but that's going to be considered after hours. Now, what's important as day traders or a trader in general is to understand the flow during the day. So from 9:30 to 11, this is where you usually see premiums higher, and you also see the volume higher. This is everybody making a plan the night before, getting their trades together, and you'll see them exercise. This is where we have high volume. This is where you'll see us execute a lot of our trades in the morning to capitalize that volume. Now, when we move further on, 11:30 to 12:30 or about 1:30, that's when everything lulls. Think about it. In New York, that's where they go take their break. That's when also other foreign markets close down. And so this is where we see a lull. This is where usually you'll see a reversal or a continuation start to happen. And you'll also see trading volumes come down. Now, from 3 to 4, that's the traditional power hour. Now, we have been noticing that a little earlier because the algos try to mix it up. So from about 1:30 to 2, you'll see a pop as well. But this is usually the second best time of the day to trade, because towards that end of the day, around 3:45 especially, that's where you see day traders exit their trades or new positions getting put on right before the close to try to capitalize the next day. So now we'll go over technical versus fundamental analysis. This is really important. Two different theories, two different ways to trade or think about a stock, and we'll go over the difference. So when you're starting with fundamental analysis, this is really the inside of a company. So you're talking about the guts. So we're looking at the financial statements, assets, what market share they have towards other competitors. You're looking at the intrinsic value, profit, PE ratios, and other environmental causes. Fundamentals really focus on the balance sheet. They focus on the insides. And when they're doing that, they're looking for the true value of the company, because normally these investors are long-term, as to where technical, that's more the day-to-day. So technical analysis, that's focusing on your price action, patterns, charts, volumes, indicators, moving averages, market sentiments. Technical deals with your day-to-day, while your fundamentals look normally your longer-term investors. And we have this here, day trading. Like I said, that's more technical because that's focusing on the volatility in that stock price. How is it moving during the day, every day? They're trying to read charts and patterns and follow different ways to trade to capitalize on that volatility near the daytime. Whereas, and that's day trading in a whole. Now, investing, you think about usually a longer time horizon, and they focus on the fundamentals. They're not really worried about what happens today or tomorrow. They're waiting for the intrinsic value of that company to grow and exceed, and that's where they'll take their profits. Now, something really important to get down and remember is risk management. Mainly, it's talking about your position sizing. You want to set a limit on how much goes into each trade based on your portfolio, and always set goals. You never want a full port. We don't do that. We don't ever over leverage into a single play. Now, when we're talking about risk management, this means setting, using only 20% of a portfolio at a time to day trade, or having your goals set out to where you're not using your full capital every day. And also it's understanding your risk tolerance. So this is where we're talking about setting a stop loss or a take profit, because it's always better to make small gains as you're going. We're not looking for that home run. So trades may go past the risk tolerance if you have your stop loss, if you have a stop loss and it's not triggered. So that's why we really want to understand where we're looking at, and our risk management has to be on point. Now, as your account increases in size, so does your tolerance, meaning, that means like if you have a small account, you shouldn't go after high beta stocks like a Tesla. You want to stay what's in your range. You want to stay what's at your level, so you're not blowing up your account on your first day. Now, here's another slide about risk management. These are what we call the don'ts. Don't average down on a losing trade. That means if it's going past your supply and demand zone and past your goal, you don't want to just keep averaging down on the trade, hoping it's going to come back, because 9 times out of 10, you're just going to go down the rabbit hole. So we highly suggest don't do that. Like we said, don't get greedy. You're not looking for home runs. You're not looking for the next GME or AMC on every single play. If you start stacking those steady gains at 25% and you be consistent about it, you'll see your account compound and surpass wherever you get, just trying to YOLO in or hit a home run. Like we said in the beginning, you don't want to be over leveraged on a single play. You don't want to go all in. You want to make sure that risk is always managed. You don't want to over concentrate on one sector. And this is really important. It's talking about diversity, meaning you don't want to be super heavy in just tech and not be exposed to other sectors. The market works, it rotates, it's in a rotation. So now we're focused on defense and consumer staples and energy as well. So if your portfolio was focused on everything as a whole, or you had a little piece of pie and everything, as tech's going down, you would have those other sectors that would perform, and in turn will create less downside in your portfolio. And like we said before, don't stay in a contract that is too far away from the stock price. That means if you're in a position and you see the stock going the other way and it gets 6-7 strikes out of where you're comfortable at, the likelihood of that coming back is slim to none. So you want to stay within that range where that contract makes sense. Now, startup capital. I get this question a lot. Zach does too. What's the best to start out? Here at iTrendz, we suggest save up to that $2,000 or $2,500 because it is extremely hard to move it. Start an account with $600 and move it. If you think about it, here at iTrendz, the majority of our contracts that we're looking at or plays we're looking at start at $50. So essentially, you would only be able to purchase 10 of those contracts, or even higher up, those contracts go for $125, $200 at a time. And it's really hard to manage that $600 to even have an average down or take any losing plays on it because that starting capital is so low. That being said, while you're saving up to that $2,000 or $2,500, there's other things you could be doing. You could be listening in on live. You could be watching videos, reading our ebooks, really getting a grasp on the market. And there's also paper trading. I suggest everybody who's getting started in the market and just trying to learn, paper trade for a couple of weeks. This is house money, monopoly money, but you can get a real vibe for it. Now, what I will say, if you do start that paper trading, which we highly suggest, do it with a realistic amount. Don't say you're going to have a $2,500 account. You put $1 million in your paper money because you want to trade in the way that you would. I've heard somebody go, "Oh yeah, I put $20,000 in on QQQ and I made $170,000." And I was like, "That's great. When are we getting started with your account?" He goes, "Oh, I'm just getting the hang of it." You want to act like you would in your normal account, so that way when you do switch over, bread and butter moves super smooth. Now, this is something really important, and I hope everybody takes note of that big giant red X right there in the middle of the screen. That is Robinhood. That is what we do not use, and we shy away. Fun, no, don't touch it. Super hot. It will burn you. That being said, the reason we have that there and we don't suggest Robinhood is for actually a couple of reasons. A, they have payment for order flow, meaning that they try to jump ahead of your data. B, and the main reason we do it is when we're talking about option contracts, the fills are completely off, meaning that I can enter on Webull a contract that's $1, and somebody on Robinhood, and this has happened multiple times, gets filled at $1.35. That means you're already $35 behind the wheel, even before we started to get rolling. So that's why we shy away from Robinhood. We tell people that if you're a beginner, we definitely want to start up with Webull because it's ease of access. And I'm actually going to show you a screen here next why it's easy. And then when you get more advanced, look at a broker like TD Ameritrade and use Thinkorswim because those are more advanced. It has a little more integrated interface. And Zach will go over that screen. You get to see it. This is Webull. This is my quick setup guide for Webull. Anybody that joins the Discord, love to set it up. The reason Webull is so easy and it has like an ease of access is because everything's on one screen. You have your price ladder there. You can see your order when you want to put a new order in. You have your charts in the corner, your option table when you want to access it, and your position. Having it all on one screen makes it extremely easy to trade. And as a new trader, you want to focus on your play. I have a lot of people that will read our watch list and they're like, "I'm in this play, this play, this play, this play," and they're in 6 plays and they can't manage each position. If you're watching your trade go out and managing your stop losses and your take profits as a new trader, you only want to sit on one position. And everybody who's in the Discord, if you watch the way I trade, I only trade 3 positions. It's about the amount of money in the trade, not the amount of trades. And that's something as we move forward, you'll get to learn, but it's really important to remember. Now, here's a couple of advantages of Webull. Like I said, all on one screen, easy to use. And a benefit of Webull and being associated with iTrendz is that Webull gives you a couple free stocks to start out with our referral code. So we're going to post this in the Discord, and Zach will get on that towards the end of the day. But just by, you can write it down too, just by using that code right there, it'll give you free stocks to start out with. So it'll have you deposit like $100, but it'll give you 5 or 6 stocks. I don't know how many it's at, but it's just something to get you started. You know, it's a little buffer money. It's like DraftKings. We'll give you $100 to throw it in here. So, but it is really easy to use, and definitely take a look. Now, there are 2 different type of accounts, and here at iTrendz, we shy away from margin, but we'll break down the 2 different kinds. So a cash account is there's no PDT. Your trades are liquid every day. So that way you get your money right back. Now, if you're buying a stock or selling a stock, it takes 2 days to settle, but with option, that's the next day. So if you want to day trade and that's something you're really interested in, the benefit of that is you can open a contract, close it on the same day, and have that money available right the next day and keep going. And it's great for new traders. Margin account, $25,000 has to be in that account. And if you're a new trader with $25,000, it is a whole lot easier to use that cash and deploy it. You don't want to get on margin because you can get really, really behind. Same rules when it comes to clearing, but we don't recommend it for new traders. Now, let's talk about this. Market news. This is really important because you can see a bazillion news outlets going out there, and these are some of the ones we recommend. So we have FinViz, MarketWatch, TradingView, and Cnbc. TradingView, great for charts. Zach's going to go over it a little later, but they had the way you can view charts, the way you can look at diagrams, look at different people on there, the different indicators. It's just a really smooth, free platform that you can use just while you're getting the hang of charting. Now, Yahoo Finance, that's something I recommend to everybody when you're looking for a stock and an outlet that has all the news on one page. It's something that I use from time to time. It's completely free, and it has all the news right there in the same spot. CNBC, obviously, I said before, I watch it on TV, but the best thing about CNBC is that they have a phone app that you can download, and you can put your watch list right on one spot, and that's something I use actually as like a quick look. Now, something I have to say about all these news sites is you have to take everything with a grain of salt. If you watch CNBC on TV, you'll hear them all the time. Oh, so-and-so is a CNBC contributor. Well, what does that mean? They're giving CNBC money so they could come on there and portray their views. Now, I know anybody's watched CNBC, they may have the analyst doesn't own the stock, doesn't own this, doesn't own this. Well, they may not own that single stock, but like we said before, they could own the indices, they could own the basket, and then technically they're not lying, but they can sway you a certain way. So any of these news outlets, you always want to take it with a grain of salt. Same thing, something I recommend everyone to use, and with the rise of social media, is starting a FinTwit, a Twitter that follows just financial accounts. When you look at news that's coming through, it's not only going through your snail mail, your Bloomberg, CNBC, your Cap IQ, your dinosaurs, something that retail trading's, then becoming a large part of the market, is that they allow the information network to really flow through. So I recommend starting a FinTwit. When you do, I have a couple more accounts. There's a list there, but just start following some of those accounts. They really do a great job with putting out news as far as current news, what's happening in the world. And it really just gives you a sense of where you're at. Like, we have our own Discord. You see a lot of pages on Facebook and Instagram. That always helps too. Something I do have to say with social media, though, is anybody can post their view and anybody can say what they want. So when you take a grain of salt from those news medias, they actually have to have a little control. Social media, anything they want. Now, if you're following the right accounts and you're following the right news, that'll give you a little insight onto what's happening right away. With that said, Zach's going to get going on the TradingView overview and go into a little more detail on just charts.
What up? What up? Highly recommend. Oh, we get a little skippy there. Highly recommend Delta One on the Twitter note. He has, in my opinion, he has the best news feed. You could get away with using the MarketWatch and CNBC apps, but I'm 99% sure that Delta One's news feed, it streams straight from Bloomberg terminal, and it's immediate. It's not like you're late a minute or late 5 minutes or late any amount of Delta One, Walter Bloomberg is right on there. I don't know if that's his actual last name or if it's just ironic because he's getting the feed from Bloomberg Terminal, but it is personally, in my opinion, it's the best of the best. That's what we use for our market news channel. And we've been using it forever, and I don't think we'd use anybody else. There's a few other accounts in there that are great for some maybe news elsewhere in the world, like whether it's, from China
Market
or just
Rebellion is really good for current news.
Current news, Market Rebellion, exactly. Or if you're looking for any type of global news, there's definitely people that was in that list that you can check out. But if you're looking for very relevant, especially Fed news, what's going on with the Fed, what's going on with anybody that's speaking from the Fed, et cetera, Delta One is like top notch. Anyway, let's get into TradingView. So if you guys remember, some of you guys came in from just direct to the registration page. We actually have a separate Discord that we set up as well for the group, and we can send that invite in here in a second. But the people that were in there, they saw that video. I told you guys to get your TradingView account set up. If you didn't, no worries about it. We're just going to go through and just check out how you can actually use this to your advantage. A lot of people do trade on TradingView. If you're using Webull also uses TradingView inside of the Webull platform. So it's good to get a feel of TradingView if you plan on getting to Webull. And there's also other brokers that do the same thing where they just use the feed from TradingView. But this is a very, very popular it's not a brokerage, but just a charting company. And so I personally don't chart on it very much, but it's beautiful. And the way that it looks, you can add a lot of text on there. It's very versatile and what you can actually do with the chart. So it's very, very nice and user friendly as well. So if we look at the top here, this is going to be your toolbar. On the top toolbar, you're going to have a bunch of different icons here. We're going to look all the way on the left. This is going to be your symbol search, as you can see. So when you click on it, this is where you'd search up the company or stock that you're looking to trade that day or the indices. So say QQQ, right? Spencer's been mentioning QQQ. So you type in QQQ, you press that enter button, and then it'd come up. Oops, there's that. That's a diagram from later or for later. But this is QQQ, and the chart from QQQ pops up right in here. Right next to it, you have your time frames, which we'll get into a little bit later on day 2. We'll get into what time frames you use for what type of trade, et cetera, et cetera. But generally speaking, if you remember this rule or law, it's almost like law of iTrendz. Zoom out, actualize what's going on, and then zoom in, and then actionize. So remember that. Zoom out, actualize, zoom in, actionize, or replace the actionize with monetize. That's the real saying there. But anyway, so you can see that we're on the 1 hour time frame. That's this next icon right here. If you click it, it brings down this drop down menu where you can then cycle through your different time frames. So if you're looking for a larger time frame, we can go to the monthly here and see what QQQ looks like on the monthly. Now, sometimes when you bring up a time frame, it's going to look all distorted like this, clearly you can't see anything that's going on here. There's 2 simple ways to get this back to normal where you can actually see what's going on. The really easy way is to just click auto down here. The only issue with this is that once you click auto, it auto stays on, and then you can't move the graph up and down if you would like to do so. So then you just click it back off again, and you can then move the graph up and down again. The other way to do it is by looking on the right side where the price is located and then shifting up and shifting down to compress or expand the price there. And then therefore you can also do that on the bottom here in the timeline where you can then compress and expand the timeline to either, expand it if you want to see it in a wider view, or then compress it if you're like, I want to see more of a larger view here. So let's go back. You can see the monthly, you can see the weekly, the daily, the 4 hour. I'm sure that some of the people that have experience trading are recognizing some of these time frames here, the 1 hour, the 15, the 5 minute. You can even go down to the seconds, but I'm not trading on a 30-second chart. That's just me personally, but there are people that utilize that, and that's for a different conversation at a different time. Right next to that icon, you're going to have the different candlestick or the different way that you're going to actually view this chart, the data that you're looking at here. Most of the time, at least 80% of the time, people are using regular candlesticks where if you're getting buyers into the market, the candlestick is going to be green and it's going to be a whole bar. So it's going to be just like you see here, it's going to be whole green. And then when the sellers are coming to the market, it's going to be whole red. Now there's a bunch of different options in here. You can check it out. They have hollow candles. So the greens will be hollow, the reds will be whole, or you can flip it and you can go red hollow, green whole. Now, a lot of people do use the Heikin-Ishi candles here as well. That is also a very favorable way to look at the candlesticks. This is totally different. Basically, you're looking at the same data, but with these specific candlesticks, it alters the data to make the true data of what goes on. It uses volume inside of it. We're not going to go into that right now. We're actually going to go and divulge candlesticks here in a second. But anyway, let's bring it back to candles. You can change it to whatever you like. I'm sure if you've ever been on Robinhood, you know and recognize the line graph here. That's what they use on Robinhood. So let's go back to the candlesticks. Right next to the candlesticks, you're going to see the indicators icon. So this is where you're going to add your indicators. You're going to go in here and say you are looking to add, like Pierre said earlier, he's using the anchored volume weighted average price. So that's the anchored VWAP, right? Or maybe you're looking at the moving average. So we go in here and type in the moving average, right? And then you click on it and then it added into the chart. You can see that it added the moving average. And now what's really cool about this, let's drop down to like a 4 hour here just so we can see like a little bit more. Let's auto it. Boom. See, that's a nice little feature right there. Nice and quick and simple, but make sure to double click there so that you can move up and down. So if we click on it, we right click, you can see, or actually, sorry, you double click on it here. There you go. If you double click, it'll pull up your settings and you can change the length of the MA or the EMA, whichever you're using. Right here, we're using the MA, just the regular moving average or the simple moving average, the same thing. So say you want a 21-day length moving average, right? So we put 21 in there, you keep everything the same. And then maybe you want to go into the style, change the color of it. You can change the color here to yellow, orange, red, whichever you like. Probably not red because you're going to get a little confusing there. But then you press OK, and then it adds it to the graph. Now, if you didn't want to, you can see I have 4 different indicators on here. If you wanted to either hide it or unhide, you can come in here and press this I. So like, for example, the VWAP is also on here. So if you wanted to unhide the VWAP, you'd press this little I in here. You can hit the settings to bring up the settings, of course, that would bring up the settings. Or if you wanted to get rid of one because you had a double in here, you could always just press the X and then that would get rid of it on your chart. So those are the indicators in there. We will break down a little bit going on day 2 and day 3. However, like I said, we're going to be giving away a few of those ebooks that actually go over a lot of indicators and patterns inside of there. So be on the lookout for that. In here, you can have indicator templates. Personally, I've never used this myself, but as a trader, it's always cool to kind of fiddle and explore new things. So in here, these are just different templates that I believe the users and the creators of TradingView have created for you. So if you wanted to check out the different templates that they have on here, feel free to check that out. If you wanted to create a specific alert and say, okay, when a stock crosses this price, alert me. This is where you would create that alert. There's quite a lot of customization that you can have in here. Show your pop-up. You can even send an email, notify on your app. If you are using TradingView to chart, which is a great platform like we've been talking about, the app is very versatile. It's very easy to see what you're doing. You pinch and pull to move the screen around. It's very, very simple and user-friendly. Definitely recommend. But this is where you add your alert for when that stock is crossing up or below, or maybe it's just sitting right in that range of those prices. Now, this is the replay function. This is what you would use if you were to backtest. Unfortunately, this function is only available to the people that pay. This is a free service, and you do have that option to go free and remain free forever. You do get an annoying amount of ads. It is very, very annoying, actually, especially if you were to actually use it when you're trading, you'd be clicking through the ads. However, the replay, if you were to like to backtest, this is a great function here. We'll be using this later, but you just click this button here and then say we wanted to go back in time to, let's say, January 3rd. It get rid of all the pricing action, and then we could go through and backtest our strategy, see what the VWAP's doing at this time. How do we trade with the VWAP, or maybe the RSI or the moving average, et cetera, et cetera. So it's a very cool function and tool there. Now, if we look over to the right side here, there's a bunch of icons here. Realistically speaking, a lot of these you're probably not going to use. The ideas is awesome. That's where you'd write down, okay, I'm thinking about taking QQQ above 295 here. I'm thinking about taking it below 290, et cetera, et cetera. That's where your ideas would go. Now, moving up the list is really where you're going to want to focus, the watch list and details, right? So this is where your watch list is going to be. So I already made one here, but let's just go ahead and delete this. How would you even do this? Clear the section. Yes, please. So you'd go in here, you'd make your new one, and you'd click this plus button to add a stock or an indice to the actual watch list itself. So let's say we wanted to trade QQQ. Let's say we want to add in maybe Microsoft, just some of your favorite companies, right? Especially if you are newer traders, think of the companies that you either use or see daily: Apple, Microsoft, Starbucks for those excessively overpriced coffees that are not even really that good, but the refreshers are good though. I already know, you guys know what I'm talking about, those strawberry refreshers. Let's see what else. We can go in here and we can add Starbucks. Roku is another one. Netflix, right? They just had the fall of a lifetime. Disney, great call out. So you can add these stocks in here very, very easily. You just go in, type in the ticker symbol, or if you don't know what the ticker symbol is, you can always type in the company like Moderna, right? So you don't know the ticker symbol of Moderna, you can come down here, listed on the NASDAQ. We're on the US, right? We're in the US, so we want to select the US flag one. You have a bunch of different Modernas in here. You could probably scroll for days, but we want to go all the way up, see the one that's listed on NASDAQ, New York Stock Exchange, and then click that and it'll bring it over into our watch list. And then what's really great about this is that when you're going through the day, say you were looking at QQQ, you were looking to take a trade on Microsoft, Apple, and say Netflix for the day, and you only have one stock up at a time, there's ways to open up multiple charts here. However, there's only one stock up right now. Say we wanted to sort through them, you just simply come over here, click the button, and then it's going to populate it on your chart, right? Disney, populated on your chart. Moderna, populated on your chart. Etc. So that's where the watch list function, another cool function of this is that you can just close it as well. So your charts gets a lot bigger. So now let's focus on the left side here. This is where all of your drawings are going to be. So when you're drawing your support and resistance lines, your different trend lines, your support and demand, supply and demand zones, excuse me, this is where you're going to find all of those drawings. So in here, this is your most basic trend line tools. You're going to find the regular trend line, the arrow, right? So if we want to figure out where the direction of the market is going, the arrow is going to have that nice little arrow that's showing, okay, we're looking to the downside right here. If you wanted just a horizontal line that's going to go across the screen right there, that's where we're going to be able to put that, and it's just going to level it all out. It's also going to give us a nice price on the right side right here, which doesn't always happen with the trend line, but I will show you how to do so. If you right click it, it'll bring up the settings, and then you can give price labels on the side here. You can also extend to the left, extend to the right. You can give a middle point, which is just going to give you that middle point. It's going to help show you that, right? Let's show what that actually does here. It just gives you where that middle point is in between the two dots that you actually made. You can go through here and give a bunch of different style and stats to your actual trend, your trend line, excuse me. You can also edit the text. So you could say above here to next resistance, right? And so you could leave that there. If you're charting at the nighttime, you come back up, you pop open your chart, you know exactly what's going on, right? So you can do, there's a lot of versatility to here. You can customize this a lot, and it's very, very cool in that manner because some other programs don't allow you to do the same thing. So like I said, let's get rid of this. If we were looking to say use a highlighter for whatever reason, if you wanted to, you can use a highlighter, but the main one in here that you guys are going to be using and learning how to use in this training course, or this class, excuse me, is the actual rectangle. This is how you draw your supply and demand zones. So you would click and then click below and then extend out. I did that wrong, actually. Extend out to make your zone, or a simpler way is to click and then move over and click. So now you're getting your boxes where you can identify your supply zones, your demand zones, and we're gonna be going into that a little bit here, a little bit on the first day, and on the second and third day we'll be getting very deep into it. This second one, the reason why I skipped over it is because there's a whole bunch of way more complex things in here. Really, this is just to fit all different types of traders. I can guarantee you a majority of traders don't use anything inside of this toolbox here except for the fib retracement. That is probably the only thing that traders use in here. If you're looking to learn about the fib retracement, maybe you're going to be one of the lucky winners. We do talk about fib retracements in our ebooks. Also, there's bunches of YouTube videos. Go ahead and check those out. You can also come in here and add text, kind of like what we were doing earlier with the trend lines. But this is where you're going to see more of the kind of ideas and et cetera, et cetera. You can put in arrows and such, just kind of to mark up your chart and say at this area we're looking for this, at this area we're looking for, you know, price to spike up, etc. Going down the list, you have a bunch of different things in here. If you have a bunch of different drawings, so say you have, you know, highlighter over here and highlighter over here, and then you've got the brush, etc., and you want to get this all off your chart because you don't know what the heck you're looking at. You're looking at kind of like an upside down smiley face here with like some weird eyes. All you have to do is come down here to the trash bin and then just tap it and it'll all go away. It'll make sure that everything goes away. I believe there is a way to save as well. Oh, you can lock, excuse me. You can lock all the drawing tools. So essentially that just locks your settings on the drawing tool. And then above here, you can stay in your drawing mode, which would be essentially you click this, and then you go into here, and then you can click again. And this way, if you're not in drawing mode, every time you click your trend line, it automatically goes off. So then I'm back to scrolling on the actual chart itself. Hopefully this is making sense, right? So one last thing to explain here. Oh, on the top right, excuse me. So this is where you can select your layout. Remember earlier I was saying on your watch list, you're going to have one chart on there. Well, you could actually have multiple charts if you wanted to. You could have as many charts as you'd like. But let's just say we want to look at two stocks at the same time, and we want to look at them in a horizontal view, not a vertical view, but a horizontal view. You'd come up to this icon in the top right, right to the left of unnamed. Sometimes it'll be a different name in here. And you'll come in here, you'll select that second horizontal, and you'll be able to put two different charts in here. So say we want to look at Disney. Hello. There we go. No, sorry. Say we want to look at Disney. Click on the chart itself, put in Disney. Now we're looking at Disney and Moderna at the same time. So this is very, very helpful, especially to people who are looking at, say, 3 different trades on the day, or maybe they just want to watch QQQ as they're looking at a tech stock like Microsoft, waiting for their trade and confluence with QQQ. As you can see, these charts right here are awfully similar, awfully similar. So we'll get into that in a little bit. Spencer kind of touched on that a little earlier. So let's go back to here. Hopefully everybody is getting through or understanding TradingView. Can I get a couple of yeses or nos in the chat? If anybody wants me to go over anything more here, absolutely can go in depth. Just a simple yes or no. RD, yes, yes. Dr. Nay, you're canceled. All right, great. So let's go back to the actual slideshow here. Get my laser out. So we're going to talk about candlesticks, right? Remember in the beginning, I showed you the icon on the top left that's going to allow you to change between your candlesticks. So let's talk about those candlesticks, right? They actually mean and show us something. They really actually show us a lot. They tell us what happened during the war on the daily candles or during the war on the 4 hours. It's essentially thinking of it like a tug of war or a war itself between buyers and sellers. Somebody's going to win at the end of the day. There might be a period of very infrequently, there might be a period of time where there's a stalemate. However, somebody usually always wins, whether it's by a smidge or a long shot, right? And I think everybody knows the difference between that smidge or the long shot candle, right? Those engulfing candles versus the hammers or the dojis, right? So on the left side here, if we look, this is essentially what candlesticks look like, right? You have your green buyer's candle, and then you have your red seller's candle. On the left here, this is your green buyer's candle. The real body, as you can see, is outlined in green. It says real body right here. When you're looking at a buyer's candle, it's going to be green. The open is going to be at the bottom of that candle here. So it's going to be at the bottom of the real body. The close is going to be at the top of the real body, right? So think about it. The buyers are pushing the market up. So when they come into the market, that open is going to be at the bottom, right? And if they're winning the battle, they're going to push the stock up and then close the stock at higher above the open, right? Hopefully that makes sense. However, there is a period of time, most days, you're going to have things called wicks or shadows, right? Those wicks or shadows extend to the top and the bottom. Those are your outside ranges, your high of day and your low of day. Sometimes those bodies, those real bodies, don't close at the high of day and the low of day. They close somewhere in the middle of the range, right? So on a green buyer's candle, your high is going to be the top wick, the top of the wick, and then your low is going to be the bottom of the wick there. And it's just directly opposite for the seller's candle. You're going to have that red candle with a bunch of sellers. And think about it. If it's going to be the opposite of the buyers, your sellers are coming into the market. They're pulling the price down, right? They're pulling it down. So your open is going to be higher than your close, right? And therefore, you're still going to have potential of the wicks and the outside ranges on the top and the bottom. Your highs are still going to be above because that's a high, right? And your lows are still going to be below. That's your low. So moving over to the right here, this is realistically what the price path looks like in a candlestick, right? This is called a hammer candlestick. So that's when you have buyers super bullish on the day. They push the price all the way to the top, right, and create a high. It then wicks down. The sellers come into the market and pull the price all the way down, close it, to a quarter or 3/4 of the way off from the highs. And so this is a hammer candle. But realistically right here, the main point of this slide is to show the price path, right? When you look at a candle like this, you have to understand how the battle went. The buyers had significant control in the beginning until the sellers came in and pulled the stock all the way back, and to close it in that lower quarter of the overall price action, meaning that the sellers really kind of had full control when it came to the end of the day, when the battle was over. The sellers had more control than the buyers. On the hammer candle that's inverse here, the red hammer candle, it's just the opposite, right? The open, the sellers are super strong in the open. They pull it all the way down, make a low of day, and then the buyers kind of step in second half of the day, and they push the price all the way back up, closing it in that top quarter of the actual trading range. So it's the same thing, just inverse, where the sellers were really strong on the day, but then the buyers, the second half of the day, they came in and they actually closed the candle just a little bit more bullish than you would have thought in the first half of the day, when the red candle was absolutely full and the real body was a lot larger, like we can see here on the left. So let's go into some general market structure, right? Let's get a little bit deeper. When we're talking and looking about stocks, what the heck is going on with the stocks that we're looking at? Well, we're trying to identify trends as traders, whether you're a day trader or a swing trader or even a position trader. You're trying to identify trends in the market. You're trying to identify, is the market going up here or is the market going down, right? Is the market strong? Are the buyers really strong and eager and euphoric to get in the market? Or are the sellers really eager to sell and short the stocks, bring them down because they don't want to be buying the stocks at these prices, right? Which is it? So a bull market, in this most simple terms, is when the prices just keep going up. And that's going to look like your uptrend, right? You might hear bull market, bull trend, uptrend. Those are all bullish, green. Buyers are coming into the market, right? And the bear market, that's when you have the opposite. That's when you have sellers or short sellers coming in and they're bringing the market down. That trend is going down, downtrend, bear trend, downtrend. I said downtrend twice, but you can get what my point here is, that the bull market, the buyers are coming in, the bear market, the sellers are coming down. Sometimes it's easier to think, if you can't wrap your head around it, the bulls, they strike up and then the bears strike down. That's the whole ideology behind that, is that the bulls strike up, so the buyers are pushing the price up, and then the bulls strike down, so the sellers are bringing the stock down. So let's get a little bit into trend here, right? So this is a general uptrend that we can see on the left. And then you can see throughout time here, I have the months down on the bottom: January, February, March, April, May, et cetera, et cetera, et cetera. So you can see trends over really long periods of time, over months, years, decades, right? Or on the right side here, you can see a smaller time frame, just over the days of the week: Monday, Tuesday, Wednesday, Thursday, Friday. A trend can be over the time of the week. It just depends on the style of trade that you're actually trying to apply in the market that you're looking at, right? But it's always important to be aware of the trend that you're trading in. You don't want to be trading against the trend. I know that's a very cliche thing, but it's really that simple. Like, just try not to trade against the trend and your life will be a lot easier, right? So maybe you might be in an overall uptrend over, say, 2 years, right? We saw from 2019, we had that nice uptrend up until COVID. We had that flash pullback. I'm not going to say crash because it really wasn't that much of a crash, but a flash pullback. And then after that low in June or so, we pushed back above those highs. And then we had another 2 years of running, just about a year and a half of excessive buying, right? But inside of those uptrends, there are minor pullbacks, 5% pullbacks, 7% pullbacks, as I think that 7% was the highest that we saw, where you can trade those downtrends, where it might be over the course of 3 weeks, you're in a downtrend, but if you zoom out over the year, you're actually still in an uptrend. So you have to keep all of that in mind when you're trading. And I don't mean to get too complex or overwhelm anybody here, but it becomes quite simple to identify, okay, we're in an uptrend here on the year, but we're getting a little overextended on the upside. So we could see some downside here come the next couple of weeks. So let's talk about that. What does an uptrend look like? This is COVID right here. This was the high pre-COVID. This was the pullback, right? Crash pullback, or the flash pullback. And then you had your highs breaking in June. And then we just had this excessive buying. And so in an uptrend, we're looking at resistances and supports. Resistances are where all of your sellers lie. So when you come up to that level, your sellers are going to bring the stock back down. The buyers are going to have a hard time pushing the stock above there. And then the support level are where all your buyers are sitting. So the sellers that are bringing the stock down, it's going to be very, very difficult for them to bring the stock below that support level, right? All those buyers are just holding the line there. Think of it, right? Tug of war, they're holding the line. So as you're going in an uptrend, It's much more smart of you as a trader to be trading the bounces off supports rather than the rejections off the resistances. And that's simply because the buyers are much stronger. As in that overall trend, the buyers are much stronger. They're much more euphoric. Whereas in a downtrend, it's actually, oh, we skipped. It's actually the opposite, where when you are getting to a resistance point, that's where you want to look to go short, where you want to enter those puts, right? Or short shares if you're shorting shares, but just sell the stock rather than buy it. If you're buying at the supports, you have a greater risk in a downtrend because those buyers aren't strong. They're not strong there, but the sellers for sure are strong. So look for those resistances to short those resistance and those rejections down through the trend, and you'll take that stock down with it and you'll profit off of it. So we want to move on to how does the market move here? The market really moves in two ways in an uptrend and a downtrend, right? And so this is the really simple way to look at it, right? And so this is a very good way, especially new or seasoned, to really think about what's going on, even on a day-to-day basis, even intraday. It's very, very important to understand this here. I keep hitting this thing. I'm going to move this. Excuse me. So we either have a rally-based rally. As you can see here, this is when the buyers step in. There's a period of consolidation where buyers and sellers are kind of fighting, but overall the buyers are still a little bit stronger. And then the buyers eventually prevail, pushing the price back above those highs and then breaking to new higher highs, right? So that's considered a rally-based rally. Makes sense. Then the rally-based drop is the opposite of that, right? Where you have a rally, the buyers come up, push the stock up, and then you have a consolidation period where the buyers and sellers are gaining, or the sellers are gaining momentum, the buyers are losing a little bit of momentum, and then the sellers drop the stock back down. So that's when you have those rally base drop or a rally base rally. Those are what you would see in an uptrend. In a downtrend, you're going to see the opposite of that. You're going to see that drop. The sellers have full control. You have that hit that consolidation period, right? Waiting for the buyers or the sellers to determine who's the winner here in the battle. And then you have the sellers bring the stock, continue to drop that stock down. Or you have the opposite there where you have the sellers super, super heavy down, dropping the stock, forming that base, that consolidation zone, and then pushing back up, rallying out of that base, right? So those are that's the two ways that the market moves. It's either a rally-based rally or a rally-based drop, or the inverse of that, a drop-based drop or a drop-based rally. So this is very, very simple. And we will also be dropping some of these slides in the actual Discord channel. Again, I'll link that here in a second, but we'll be dropping specifically this schematic so you guys can either, write in your notes, et cetera, but just detail it out. So let's go one step further, right? We talked about support and resistance. So support is where all of your demand is. That's a concentration of demand. So what is demand? Spencer went over this earlier, supply and demand, right? Demand are buyers, right? So resistance is the opposite of that. That's where your concentration of supply is, or sellers. So in an uptrend, and this is a trick question, I need some answers here in the chat. In an uptrend, would you rather buy off support or would you rather sell off resistance in an uptrend? We're only talking when this trend is going up. I need some answers in the chat. Would you rather buy off support or sell off resistance in an uptrend? Pierre says buy off support. Oh, I'm going to call you guys out, by the way, by the name. Buy support, buy off support. Okay, correct. So we'd rather buy off support in an uptrend. Why? Because those buyers are super strong in the uptrend, very, very strong in the uptrend, right? But whereas vice versa, in the downtrend, we want to be looking for those resistances, those rejections that we can then short off of, right? We want to be selling those resistances because that's where the concentration of sellers are super heavy there, and the supports are going to be weaker. So as soon as those sellers bring the price back down to support, you'll notice we just break down through it, form a lower low, a lower support there. We then bounce back up to form a resistance and then break that support once again. So that's what you're looking for in an uptrend and a downtrend. Now, one phrase that we have here that some of you may have heard, and if you're in the group, you're going to hear this all the time. We say it to everybody, whether you're new or seasoned. Old resistance is a new support. An old support is a new resistance. That's just the way the market goes. If you think about it, you can even see here on these mini diagrams, and I know these are like the perfect, most perfect S diagrams you could ever see. We're going to check out some non-perfect as well and show what the real life examples look like. But you can even see resistance becomes support, right? Resistance becomes support. You can see the same thing over here. Support becomes resistance. So the old resistance becomes a new support. The old support becomes a new resistance. Write that down. You can see right here, I drew a simple design. You can see we hit resistance, resistance again. The buyers just can't seem to get the stock above. But once we finally break the resistance, we now have the sellers hitting, we hit another level on the stock. Sellers bring the stock back down to that support. And now we start using the old resistance as a new support. Every time the stock gets back to that level, the buyers pick it up. The buyers pick it up. The buyers pick it up. So it's a very simple way to look at the market, because you'll see this. I promise you, if you did not already see this in the market, turn up a chart after we get after this. We're going to look at some charts here in a second as well. But get a chart out and just look and start to identify just a simple line. It doesn't have to be super accurate, but look 6 months ago where that support was, and now look where we've hit it at resistance. Pretty much any tech chart you're going to pull up, right? We had that uptrend. Now we're in that bear market, quote unquote. We actually did technically hit that bear market on SPY today. Fun fact. I believe it was 38.90 was the bear market or something like that. But those past resistances are now supports. I mean, those past supports, excuse me, are now resistances that people are selling every time we hit those resistances. So let's take a look at this in real life. It's not as nice as it looks in those drawings that we just showed, right? Here's your previous support acting as your resistance, your new resistance. So your previous support. And this is in a downtrend too, as well. You can see that we have PayPal here. This was back in September, October, November, right? So this stock, I believe this was actually back in, this might have even been a couple years ago. No, excuse me, rather this was not. This was last year in 2021. So anyway, we have a downtrend here. The sellers are bringing the stock down to support, finally find support where buyers step in, price or buy the stock back up, push the price up. The sellers come in and then pull it back down to support. Using that support, again, the buyers then step in, albeit not much of a war here, not much of a battle that they showed. The sellers come in, break down through, and now they use that same level as resistance. So this is really big key. This plays out all the time. You can see that we're on a 4-hour chart here. You can kind of see in between these candlesticks, 4-hour charts. So that means that every candle is a 4-hour period. We'll get into that in a second once we go back into trading view. But you can see that this was from August until like midway through October, a little bit into November. So this is a longer period, right? This is a duration of a few months here. And you're going to see that even if you zoom in and zoom in and zoom in, you'll see that this happens on a day-to-day basis, on a week-to-week basis, a month-to-month, a year-to-year, especially if you're in a highly volatile stock. So let's move. Let's continue this. Let's continue this concept here, right? Old resistance, new support. Old support, new resistance. This occurs all throughout time. As you zoom out and zoom out and zoom out and begin to actualize the chart, you'll recognize that this is how the market moves. You have these impulsive moves that create new zones in the stock, and that previous resistance becomes new support. And that's what allows a stock to move up over time. And then in that downtrend, move down over time, right? Because those old supports become resistance and you move down, or in this case, where you're in an uptrend, those old resistances become support and the buyers just slowly edge the stock up. So you'll look at a chart and this just happens time over time over time again. And if you think about it, it kind of has to happen this way because the big dogs aren't going to make their money if they're just throwing darts blindly. Like they got to have something where they're looking at a technical level for them to say the stock is back at this level, I'm a buyer here, or the stock is back at this level, I'm a seller. So if you think about it, it makes a whole heck of a lot of sense why an old resistance becomes a new support or vice versa. Old support becomes a new resistance. I've said that about 1,000,000 times. You guys better have that memorized by now. You guys will be dreaming and it's just going to be me saying old support, new resistance. Anyway, let's go into a Q&A session here just for about 20 minutes. And then we're actually going to break down some more market movement inside of TradingView. But we want to make sure that everybody's questions get answered. You guys feel free to come off of the mic, unmute yourself, or just say it in the chat, and we'll have it here.
Don't be afraid. We only bite on occasion.
Dr. Nate is jamming out in the background. I heard that. Anybody have any questions? If not, we're going to go right into trading view. What is the best way to avoid a false breakout? The best way to avoid a false breakout, and then Spencer, you can speak on this if you have any thoughts. For me personally, the best way to avoid a false breakout is one, to have tight stop losses, and we're going to get into that. So we're going to talk a little bit more, especially on day 3. I'll go into the stop loss indicator that I use to tell me that I either messed up on my entry or messed up on my exit. But to answer your question, keeping really tight stops is extremely, extremely imperative. Spencer talked about this in the whole risk management. If you don't have a stop loss level, unfortunately, in your head, you're gonna get to minus 20% on that contract or that position, and you're gonna say, well, what if it bounces here? And then it's gonna go to minus 40%. You're like, well, surely it's gonna bounce here. And then it's minus 60%. And then at that point, you're just like, well, let me just get rid of the position. And then at that point, you might be at support and it bounces up a little bit. You get a little FOMO. And then if you make that terrible mistake of getting back into the trade, then you double messed up, you double dipped. So having really tight stop losses is really, really important when trying to make sure that you're not trading false breakouts. Another thing that I personally use is on the 5-minute, I'm looking for either a couple candles, as in two or three candles confirmation above my level, or if the stock is, say, if your price target that you're looking for the stock to break above is 103 and the stock is opening up at 100, it's got to push up 3% to get to that 103, right? Or excuse me, when it pushes up to there, you're likely, after moving 3% on a stock on a day, maybe it moves 5% on average, you should be a little hesitant to enter that position until you get true confirmation. So if we remember the rally base rally, in that instance where your price target, your go long target is going to be 3% above where the stock is opening up, you wait for that stock to consolidate on that actual level. Wait for it to consolidate. It's going to do its dance, maybe 20 minutes, 15 minutes, where the buyer's going to push it up, seller's going to bring it back down. But they can't bring it back down underneath that level and start bringing the stock, dropping it back down, right? It's going to be a rally, then you're forming that base, and then you're looking for that extension, right? So you have your breakout, your retest, and then your other extension there. In other words, you have your rally, your base, and then your rally.
For myself personally, I can say 2 things about that. With the way I trade the iTrendz 4-to-1 method, where you're already locking in 25% as it moves through. So it kind of protects that if you were in the contract at the right price, gives you a little leeway when it comes to buying up or down or accurately coming in. Second, to avoid that false breakout, what you should really have down is your support and resistance levels. And also, you should also draw out boxes that make it a lot easier for you to realize that trade's going to extend or push up past it. Now, with day trading, a lot of people in Discord follow, I use a 5 candle method, meaning if I have my support level, it has to hit over that candle it has to hit over that level 3 times before I'll even enter the trade. Like Zach was saying, consolidation, day trading is a little more short term. It has to consolidate there to show me that it's a level that's key and that we push past it. If you're using that 5-minute, watching those candles confirm over that level, you have to make sure that they're confirming over, and at the same time, having that stop loss at a level that makes sense for you. For me, I trade the 4-to-1, so 25% is where I cut it out. But when you get more and more advanced, it also helps you protect that average in, or protects your profit and losses. And we'll get into that further on the last day with my trading method. I'll show you a couple examples to where I actually draw out the boxes and I use different color codes to tell myself, okay, this is where I'm going to enter in. This is where my top resistance level is if we're going a different way. And then I'll also have a range above it, knowing that if it touches in that range or it clears that range, I'm completely out of the trade. But something you should focus on is just your charting and having your levels set, and then also having where you're going to take your profit or levels where you think a new resistance is or a new support is, having those already marked out. So you're not trying to guess while you're in the trade where it's going to go, already having targets set higher on the list in the direction you want to go. So that way, you know, as a trader, that's where you want to be. And then using that stop loss is extremely key.
Cree says, is there a time frame that's better to chart for day trading versus swing trading? Absolutely. For me personally, and then Spence, you can talk on this too. I know that I know we use actually a little bit different, just a tad different. Personally, for me, excuse me, I really don't swing trade that often. Like you'll see day three. I'll tell you my quanta. If you wanted to quantify it, I'm about an 80-20% swing trader versus day trader. However, in all reality, I'm probably only swinging 10% of the time, especially in a market like this. I really just don't feel comfortable swinging. You get a lot of overnight bounces and overnight pullbacks. And I would much rather, just me personally, this is totally not saying it's better this way or not better this way, but this is just me personally. I'd rather wake up and not have to manage a position and focus on my trades that I know are going to execute, that I'm going to be able to execute on that day, rather than having to manage that position and be like, oh, like, well, what if this position comes back, et cetera, et cetera? We're going to reject here. So I have to watch this. I have to give up one of my trades because I have to manage this. It didn't go my way. It bounced overnight. And that's just not me. I'd rather just wake up, have my 3 to 4 trades that I'm looking at on the day, and then just execute on those trades. Put all my focus towards those. That's just me personally. Now, to answer your question about the time frames, for day trading, I'm looking a lot. I zoom out and then I zoom back in. Generally speaking, every trader is going to zoom out and zoom back in. Well, I start with a daily and I just look at the daily candles because I want to look at the sentiment from that tug of war that occurred, right? In that daily candle, I'm going to really be able to see the price path. What happened? The buyers had control first. They had control all the way throughout the day. And then the sellers came in and just ravaged the sellers. I mean, the buyers, excuse me, brought the stock all the way back down, or vice versa, right? The sellers came in, even just like today. If we look at QQQ, the sellers were super strong. Then second half of the day, the buyers were actually quite strong, coming in, pushing the stock all the way up. Did the candle close red and the sellers have majority control? Absolutely. But you can't ignore the fact that the buyers stepped in and cleared 2/3 of the candle, the candle that the sellers had already brought down. So I look at that daily candle, get the sentiment of what's going on. Sellers, are the buyers winning? Are the sellers winning? And then I look at it a little grander scheme. I might look at it the past week and what's going on. Are we oversold on the RSI, which is an indicator that I'll get into on the day 3 that I use just to look at common oversold and overbought levels. They then zoom in on the hourly because I want to get more of a relevant idea of what the trend is doing. So are we in a downtrend for the last 3 days? Are we in an uptrend for the last 3 days? And I'm looking at the hourly and 15 minutes to get my levels because you can identify the consolidation zones or the bases after the rallies or drops where all the buyers or sellers are sitting, right? So if I'm looking left on the chart on an hourly and I see there's a consolidation overhead, then I can expect that there's going to be a lot of sellers there when we meet that price again. So I have 2 ways of going about this. If I like the trade up to that level, I might take the trade up to that seller's level where that resistance is, right? Or that supply zone, right? We're going to get into that concept a little later, but that supply zone, that resistance level. And then maybe if I don't want to take that trade up to that level, I don't like my risk to reward, right? Just like now, I would rather take the rejection off that zone. Then I'm going to wait till the stock gets up to that level. I'm going to allow the stock to trade in that level for maybe 15 minutes. I'm going to let it hit it, pull back a little bit, retest, truly fail it, and then enter my rejection trade, my short trade down, right? And or in the vice versa, where the instance where the buyers actually get back above that level, then I might wait for the base to occur where the buyers push it above, retest it as support. The old resistance is now being used as a support, watching for it to become support, and then take my trade on the break of that and have my next level that I already have charted out, trade up to that next level. As for day trading or swing trading, a lot of swing traders, at least to my knowledge from all the traders that I talk to that are heavily swing traders, will use the day chart, the 4-hour, and the hourly. Spencer, I don't know if you want to talk on that.
I would love to. So when I am charting for a swing trade or just in general, I always start out on a larger time frame. So a weekly, a daily, I'll always have that chart drawn out where my support and resistance are. Then I'll change colors as I'm moving in. So on that 4-hour, I may use a yellow color just to mark a little more intraday, a little tighter ranges. And then moving in even farther, I'll go to the 5 minutes to really clear up a small block range. And that's kind of how I move. For that swing trade, I'm really focusing on that monthly, the weekly to the daily, because on a swing, we're swinging it for multiple days. So we want to see what the bigger picture is. And so I always say zoom out and then zoom in. So for that swing trade, you're looking at that month toward the weekly and towards the daily. There's also indicators that help you with that, which one of them big time is VI, and which we go over that in our book. But that's what I'll use when I'm looking for a swing trade. Now, when I'm considering a day trade, I'm really focused on that 4 hour because we're looking for that short movement. And then when I'm actualizing that trade, if I'm trading a day trade, I mainly focus on the 5-minute candles. So I'm moving along with the chart the way I trade, which I'll go over. You'll see it live and in action. I follow that 5-minute to follow that trade just to secure that I have the right entry and then move on from there. But it is important on the time frame. Like I said, for that swing, focus on your bigger ones, your month, your week, your day, and then zoom in. But even on that day trade, you want to start outside just because it'll give you that overall picture. And then you can tighten in and really look where we're seeing it's going to move on that day.
Okay, Mr. Brown. Oh, sorry. Were you going to continue?
No, that's it. You're good.
Mr. Brown, I'm sorry. I don't know how to pronounce your first name, and I do not want to butcher it. So he is asking how to identify a pullback versus a full reversal. So personally, right, let's go back to the whole trends, right? If we're in a downtrend like we are, you're more likely to get a full reversal when you meet that resistance than just a pullback, because if you've noticed, if you've been tracking the market, I don't know how it seems like you're active in the market, right? Just from what you've said in the chat. So you've noticed hopefully that all the buyers that step in, all these bounces that occur, they're very short-lived. They might only last a couple hours. The other day they lasted maybe 3 days, right? It was maximum 3 days before we saw that huge reversal. And we saw one push back up to that resistance level and then a huge reversal again. So in a downtrend, I'm looking for full reversals, whereas in an uptrend, I'm looking for just a minor pullback and waiting for that base to form and then a continuation thereafter, right? However, there are two ways to go about this. And actually, Pierre kind of touched on it here in the next question. So it's kind of like a double answer here. So you're either going to trade, as a trader, you can trade both of these methods. You can either trade the breakout, or you can trade the retest and then continuation, or the drop thereafter. And it's definitely applicable to trade either. You're going to have a higher success rate if you just wait for your consolidation period, but you are going to miss out on certain explosive, impulsive moves. So you have to figure that out for yourself as a trader, whether you like to trade the more risky breakout rather than wait for the actual consolidation to then trade the continuation or the drop. You have to figure that out for yourself, because that's really dependent on your risk tolerance. For me personally, I don't trade breakouts as much. However, there are certainly stocks that I'm looking to trade breakouts in. I'll give a specific example here. In the past Roblox. In the past 2 weeks, semis, right? Specifically AMD has been seeing lots of buying. If you look at QQQ, it looks like this. Looks like that down, right? If you look at AMD during that same period, it's kind of like down and then it's up and then like new low, and then it's been very sideways, whereas Q's has been significantly skewed to the downside. So I started recognizing that like 2 weeks ago. And so when we had this previous bounce this past week, earlier in the week, I knew I was watching AMD every single day, watching how hungry the buyers were to buy the stock. And that doesn't mean it's going to last and that AMD is going to reverse and be inverse to the market. That's not what I'm expecting out of the stock. But I am expecting, if Q's is going to have a couple day rally, for AMD to really rally and therefore get a lot of buyers behind that. So in AMD, and you can ask Spence, we were trading AMD. Well, we traded AMD the whole week, both upside and downside. But in the beginning of the week, it was easy to spot those bounce levels because the buyers were super, super hungry. Would I have known that if I hadn't watched the stock the whole time? You could have at a glance understood that, okay, there's a clear distinctive difference between the fact that AMD is trading sideways and Q's is trading down. But it would have been a lot helpful to watch the stock as well, seeing that every time we had just a couple buyers in Q's, there was like 10 times the amount of buyers in AMD. They're just super hungry for the stock. So I used that to my advantage when we did have the bounce here, quick little bounce, couple day bounce earlier this week. So I hopefully that answered your question. I think I went
a couple other factors when you're looking at a retracement versus a reversal. The volume when it comes to a retracement, that's people just taking profits, so that you'll see like their light trades. You may not see a golden sweep come in, something like that. Now, when you're looking at a reversal, you're looking for those big block trades. You're looking for those flows to come in, SPY put coming in 4 million, coming a different way. That'll show you that institutions are stepping in, and that'll give a key sign for a reversal versus a breakout where it's just retail traders just slapping the ping pong ball back and forth. Also, when you're looking at a retracement, the buying interest during that declines. Whereas it is a reversal, you won't see many candles that are trying to push it the other way. It'll be a continued ladder step down to where it doesn't really, if went on a larger time frame, you wouldn't see anything. A couple other things is that like the short interest, if you're looking for the difference, like there's no change in short interest when you're looking at a retracement because it's too quick. Those movements happen really fast. As far as that reversal, you'll see more and more calls or more puts just keep flowing in, or you'll see the volume on those strikes just continue to grow. So that's just a couple other things. Another big thing to look at when you're looking at reversal versus retracement is that on the fundamental side, you won't see many in a retracement because it's too quick of a move usually. And then on that reversal side, that's where you'll see a change or like a speculation in the fundamentals, meaning like if we're looking at even with Palo Alto this week, the fundamentals were great, but we're in a bear market which kept it down. So you would have seen that full reversal if the price would continue up towards the top, but you saw the retracement today because the market was trending down. So the fundamentals were great, and that's why you saw the stock exceed and move up. I think it moved up 50% or something nuts over the day to day, but you saw the retracement because the market was trending down. It's not going to fight that trend. So
Pierre, I think we pretty much answered your question there. It's kind of like a double whammy. Another thing I just want to say on this topic about whole trading breakouts versus trading the actual true after the retracement, after the pullback, and then trading the retest of that. In your head, you should identify that breakout that you're trading can be short-lived. So some traders with higher risk tolerance, right, might take a starter position, and you might take a 10 to 20 position. Say you have 10 contracts, just arbitrarily, not focusing on the dollar value, but 10 contracts, right? You might take a 2-contract position on the breakout, or maybe say a 3-contract position. And then after you see that you have true confirmation of the retest, it's retested that previous resistance, now support, and you're waiting for that continuation. After it breaks the continuation to go to your next resistance level, you might then add the rest of your position there, or be it however you like it, maybe 50% position on the break, and then on the retest and successful break up to the next level, you're going to add the other 50%. So you want to keep that in mind on breakouts, that you're either going to have a very quick trade, and if it's your normal position size, consider taking a considerable amount of the trade off at your first resistance level where it's bound to create that consolidation zone, or understand that it's going to be a starter position, and then you're going to trade that up after you have that retest and that confirmation. For Poke, what up? I hope your day's going well. So for the news and charting information for the when playing earnings, Spence has a lot to talk about this. I really don't trade earnings that much. However, there is one thing I do want to say. You have to follow what the market is looking for in earnings. The market has been looking for outlook. What's going on with outlook and what's going on with supply shortages. There was a period of time for about 6 months, about 4 months ago, if I'm not mistaken, where they were super focused on margins. It was the same, it was equivalent to the how crucial the outlook was. So their future cash flow, what they're looking for, their cash flow they're bringing in, any type of assets, what's going on with the company, what they're looking to do, whether they're looking to take on more debt, etc.
How you should actually
their earnings per share are coming down, or in that period they were looking for those margins. So the margins on their capital that they were bringing back to the business. What are they are they expected to bring in 13% margin this time, this earnings, and then next earnings 16% margin, et cetera, et cetera. So you want to really take into effect, especially just during earnings in general, what the market is looking for, and then you'll utilize some other information to base a standpoint on there. And Spence has a lot to say about this.
So for myself personally, I am a fundamental trader. So I will go straight to the balance sheet. I'll compare their earnings previous to what's expected before, what that revenue has to be on jump, what their EPS is. I'll really focus in on that. Then it becomes where you're looking at company to company. So how they did my dog dirty, we'll bring up Disney. with Disney, all they cared about was streaming news. You knew that when Netflix dropped the ball and they blew up like they should have, all they were caring about was the streaming numbers. Disney, from a fundamental standpoint, $100 fair value, even without the streaming service. But anyways, knowing that ahead of time, that all they were going to look at was the streaming service, you saw the stock got punished. Reason they got punished is because their outlook was spending more money on streaming to acquire. And then they even beat subscribers. But in the overall market, if you didn't blow out those numbers, they were going to punish the stock. So it kind of goes stock by stock, but I look at the fundamentals first and I create that intrinsic value myself. And then I had to justify what the increase on EPS is and what the increase in the numbers and what realistically that stock in previous was able to do. Now I'll compare quarters. I'll look at how many times the stock has beat earnings. Like I should have looked deeper into Palo Alto because they're 19 for 20. Well, now they're 20 for 21. So shame on me. But that being said, that's the first place you go is looking at the fundamentals. That's me personally. I mean, we're still in a technical market. So everything's overpriced to me. Some stuff looks great. Some stuff does not, Tesla. But knowing that we're in a technical market as well, and that all of these stocks have been getting crushed right when they say our outlook looks bad, supply chain, we see a slowdown, or with Disney, we see increasing costs in Asia and less revenue because they're closed down. The second they said that, the stock went from 108, shot right back down. So you have to be current with what's in the news, check the fundamentals, make sure it makes sense. And another big thing is that if the company is offering a dividend, look if they've already distributed or not, because that's going to create an influx of buyers and sellers. And then look at their outlook going forward. Any dividend company that says they're going to cut their dividend or move their dividend, that will significantly influence the stock because the majority of investors are institutions. So that being said, yes, retail has stepped in and made their little splash, but we're still institution dominant. So they're looking at fundamentals, they're looking at the insights, and that's something you should do as well. Now, a strategy that's worked really well as of recent is a straddle or strangle, taking a call on one side, taking a put on the other, because these earnings have literally pushed the bucket. You can look at anything. A stock should not move 50%. I'm just saying that now. A normal stock that's been in the market, you shouldn't have a 50% swing. That being said, as we see the market continue, that's what's been working. But when we get back to a normal world, aka probably July, don't quote me, July, but when we get there, things will kind of normalize out. But why are we in this panic? Look at the fundamentals, justify it yourself. If you're not sure, let it go or ask one of us and we'll give you our best outlook on it. Best thing about being in our community is you have 4 analysts that do this every day. I couldn't tell you a day I don't look at a chart or talk to Zach or Jack or Nick. We look at charts all day long. So please, come join us and you can ping pong ideas and we'll talk about open interest, volume, what strike we'll play, all of that. A benefit of our Discord group is that we're open mic and we talk to everybody. One of us will pick you up and walk you all along, or we have a great community that they'll talk to you all night long. So come check us out.
Yeah, no cap. There's definitely people that stay in there very late. On the whole earnings note, before hopefully somebody has more questions, anybody, like I said, no question is too small, too big. Come on the mic. Like this is the day to get those beginner questions out of the way. If you're worried about, oh, this question is too small or except, don't worry about it. We're here to answer the question. This is your guys' time to get that feedback on your questions.
Oh, Zach, let me jump in one more second. On that earnings, when I said that it's crazy they're moving 50%, what I've been doing is only risking the amount that I'm willing to lose. Earnings is, you'll see in all my alerts, I'll say risky earnings because they've been coin tossing this and they've been crushing businesses that give decent earnings. But like I said, when they say supply chain issues or we're slowing down, they've been blowing these companies up. So only earnings is definitely a riskier play. So only risk. What I like to do is I day trade all day long. I'll use those profits while I day trade and I'll put that towards what I'm going to risk on that earnings play. And that has to do with risk management, but definitely manage your risk.
Mark, great question. Glad you asked it. Same with you, Myers, as well. So I'm looking at, I'm looking with the earnings. I just want to say one thing. It kind of bounces off what Spence just said, is you should look at an earnings trade as a zero or a hero. With what he just said, he's playing with profits. That's a very smart way to trade earnings. So if you make $1,000 on the day, you make $200 on the day, or whatever it is, $1 million on the day, that's profits that you made on the day. So theoretically speaking, you could just risk those profits. If you risked $1 million after you made $1 million, I don't know, I might question that, but if you did risk that 100% of the profit that you made on the day, then theoretically you just start the next day at the very worst case scenario, what you had the day before that you started at. So that's a really smart way to approach it. And in general, you should think of earnings as a complete lottery. So you're looking for it to either go zero. You're looking for it to go above, above and give you some greens, but realistically look at it like it's either a zero or it's going to be 100% banger, or maybe 1,000% banger, etc. But giving yourself on both sides that put in that call is definitely super important. So Myers, Mr. Myers, yeah, we got a couple doctors on board. So if you have any questions about health, those are good people to go to.
Yeah, I got a spot doctor somewhere. Can we check that later? I heard.
Yeah, dude, I actually do have some questions about blood pressure. So Mr. Myers, so what do we recommend for brokers? So for me personally, I used TD Ameritrade, Thinkorswim. It's a more complex platform. However, that's just what I learned on from the very get-go. I've been trading for 2 years. From the very get-go, I used Robinhood for like 2 months, and then went straight to Thinkorswim, and I haven't looked back. That's just me personally. Spencer uses Webull. Lots of our members use Webull. It's very, very user-friendly and very easy to navigate, etc. Thinkorswim has a little bit of a learning curve to it, and it looks really confusing when you bring it up because there's so many tabs and things going on. But realistically speaking, once you kind of divulge and get into it individually, there's really only 3 things that you're clicking. So it is very simple after the learning curve. That's me personally. As far as syncing to TradingView, Webull does not sync to TradingView. I'm almost positive that E-Trade, which is not the best options trading platform, but I'm almost positive that E-Trade will sync to it. I know TradeStation will sync to it, and you'll be able to see your trades there. So you'll be able to you can execute on TradingView, but there are certain brokerages that don't partner with it. TradeStation is a fairly good, from what I know. I actually just opened a brokerage account to check it out. But from what I know, TradeStation is a pretty solid options trading platform. So there are platforms that you can bind with TradingView. Definitely do a Google search. I'm 100% certain that you can't do it with Thinkorswim. Webull, I'm not so sure. E-Trade, I'm like 90% sure you can, and TradeStation, absolutely. So let's see. How do you identify what stock to trade? Mark Willis, this was a great question. So this is, I want to break it down this way. Large caps and stocks with high volume is where you want to be. So if you're looking at, let's just bring up TradingView, right? Like, hold on, let's just bring up TradingView. This is what I want to. Oh, you just got a day 2 little agenda there. Let's go back to the one charter over here. Let's go back to the watch list. So remember in the beginning, I said, just think of some companies that you think that you know. Generally speaking, those companies that you know are probably going to be pretty large, right? So if we want to focus on the tech sector, which is where you're going to see all the volatility, lots of retail traders in there, lots of volume, generally speaking, that's where you want to be in most regards. However, there are certainly other sectors that you can go to trade other sectors. Absolutely. Figure out what you like to trade in certain sectors. Some move slower than others. Others move much faster. There's a user in here whose name is Arthur. I'm going to call you out. And he's a really solid longer term trader. So he'll take the trades that we have for tech and he'll buy an extra 10 days a time or 20 days, 30 days a time. And then sometimes he'll come on the mic and he'll be like, yo, what do you think about, oh, what am I looking? I'm thinking of this dinosaur stock. What do you think about Colgate? What do you think about this stock, this older stock, GM, General Mills?
How does Intel move?
Intel move, which are all valid companies to trade, but you have to understand that there's a frame of reference. There's a frame of reference that you need to apply to those stocks. Microsoft, Apple, Starbucks, Netflix, those stocks are going to move like aside from Apple, 5% in a day, or even 10% of it, or 50% like Netflix, right? You're going to have very volatile markets. Those other sectors, might only move 2% a day, maybe 3% a day, and it's going to be real slow. It's going to be like you're going to be waiting there thinking that the chart is frozen sometimes. But that doesn't mean it's a bad trade. You just have to recognize that you're not going to get your quick scalp trades in those older stocks. You're going to get quick scalp trades in those tech stocks, right? So moving forward with the question here, think about those companies that you like, right? Not like, but know of: Microsoft, Apple, right? We're going to talk about Starbucks, those three things that I already listed, Disney, Moderna. Those are all stocks that you can trade in there. Think of some more like PayPal, right? Another one that's newer to the market that I'm sure you've heard of, Affirm. That's a great one. Roblox, where everybody's kids and just absolutely wipes everybody's credit cards off of. Oh, look at this. We're getting all different types of things. I've already charted out these. Some semis, AMD, NVIDIA, QCOM is another really, really awesome one. DocuSign is a great stock to trade, very volatile, kind of hard with the contracts and the way they move. However, good to add to the list and watch. Let's see what else. Oh, these aren't being added into here, but anyway. Let's see, Dollar Tree, Dollar General. If you're looking the oil route, you're thinking Exxon. So let's just add these in because I thought we were. Exxon, CVX. So stocks that you know of. Think of stocks in different sectors that you know of and concentrate on those. And before you trade a stock, either simulate a trade or just do a tester position that you don't care about losing. Maybe only like a $50 contract, or like one share of the company just to see how it moves or something like that. Because you really want to understand how the stock moves before you just jump full on head, just full on jump into the water with it. Because the stock might look good on paper when you zoom out. You're like, wow, that's really consistent movements. But then during the day, it could trade completely different to what you actually are seeing on a larger time frame. So definitely recommend kind of checking out the stock and watching it for a few days before you actually trade it. Like we do Sunday and Wednesday, we do market preps open to everybody in our Discord. And so people will bring up all these different tickers, and they might bring up, just random companies that neither Spencer or I have heard of, or most of the chat. And a lot of times they come up and we'll talk about it, and I'll be like, I like this setup, but I've never traded it before, so I have no idea how the stock trades. I really like the technical setup. Looks like it's going to this level. We can see a rejection there because we're in a bear market, etc. And I'm less likely to take that trade because I don't know how that stock trades. But I can tell you how AMD trades, how ARK, the ETF, trades, how Microsoft trades. All these stocks that I look at on a daily basis, I can tell you how those trade, and then we can trade those daily. So when you kind of narrow down that focus, it's nice because you have a smaller basket of stocks to focus on, and then you're focusing on those 12 stocks, and then you look through those 12 stocks every day, and you find 3 to 4 high probability setups that you like on those stocks, and then end up trading those. So anyway, I don't know where the Spencer, I don't know if you have anything to add on that. All right, let's see. Hopefully that helps. Mark, Lauren, how can I offer you something I'm good at to learn from you guys? we don't take any type of solicitations like that. Just hit us up on our Discord, and we can go from there. If you're more advanced on trading, just feel free to send Spencer or myself a message, and we can hop on a one-on-one and see where you're at. Okay, so you don't see TD Ameritrade Webull on there. Okay. List of brokers and TradingView. No, TD Ameritrade are definitely not available to pair with TradingView, and Webull is not on there apparently as well. Yes, day 2 for the stop loss. We'll go over how to stop. There's a brief, and Spence goes over it. There's a brief image of how to set up a stop loss. Yeah, dude, TOS is amazing. Pierre, answer that in a question here. I mean, in a second here. Yeah, NVIDIA, Snow, Coin. Coin is another one. I actually put a coin trade in my watch list today. I really don't trade coin too much, and it didn't move as nicely as I wanted it to. I put the levels, I set the levels there. I watched it. I didn't really like how it moved. That's not to say that it doesn't move. It moves like that all the time, inconsistent. But I'm going to keep my eyes on it. Maybe I'll like to trade it. Robux, nice. Exxon, yes, sir. Okay, so going to Lauren's coming back in here. Carmine, I'll answer you in a second. Going back to Pierre, how to properly play a strong overnight gap without chasing a move. So personally speaking, I actually silently swung calls overnight last night. And it was realistically all off of, I wasn't going to do a straddle because I didn't really want to risk that much. And I was more on the side of it was a complete lotto. I was okay with losing the contract, but if I gained some on the contract overnight because of a harsh bounce, then okay, we're great. We traded a little sideways yesterday, and we closed above my level. I don't have it on top of my head, but we closed above my level on Qs. So I was comfortable with taking calls and less comfortable with taking shorts. I didn't see us gapping further down to our lows. I expected us to trade back up to our resistance because we had only touched it one time, truly rejected resistance and then come down. Turns out that we gapped up, barely even touched that resistance and then came down. However, I swing calls on a full lotto position. Usually, like I said, I'm not one to swing. There are certain markets where I like swinging more so. If you see the pattern on the day, like I'm gonna bring it back to like September of last year or even August. You really could have swung any type of calls. Tesla, Apple. All you had to look for was a flag formation, which if you don't know what that pattern is, we get a little bit into that on day 2 and day 3. That simple flag formation, if you see the push up and then it just consolidates the rest of the day in the extreme euphoric market, all you had to do was buy some time on the contract, wait for the formation of the flag or maybe a pennant that you're watching, and just wait for the formation to play up, and it would usually gap up. And that's just the way the market was. Now it's a little bit wishy-washy where you have a lot of gaps up and gaps down to grab liquidity and orders. Those are and order blocks, which are two concepts that are a little bit more complex in institutional trading. And for me personally, I can see the movement, but I never actually execute on it. Last night was just one random execution. I'm like, you know what? I'm going to buy this Qs contract. I can see us gapping up a little bit overnight, and I profited off of it. Because I don't do that very often, I'm not going to do it for months now. Spencer, I don't know if you have anything to say on the overnight gapping.
I let him go.
You just normally let him go without swinging.
No, I mean, it just depends on what you're talking about. Like if we're talking about the indexes, then I have my levels set to where they're going to reject. Other than that, or I'm in a swing or I'm in a longer out play that'll protect that position. For myself, I follow where we are in as a bear or a bull market and know that we have opportunities to reverse at any point. That being said, I use a 4-to-1 or a trade in, trade out method to where I can capitalize on my profits. So that way, if we, I'm taking profit at 25, 50% coming towards the end of the day, that I know if we have that gap up, I can apply that 50% capital back into the play and continue with that gap or not chase it in a way. But mainly, if I'm looking at a strong overnight gap, I want to see that consolidation at those key support levels and really figure out where that should push and continue to push to actually confirm that overnight gap. We haven't really confirmed or pushed past a lot of these points. I mean, if you're looking at, pull up QQQ, please, Zach.
Nice and quick right there. Love that feature.
As you can see with on QQQ, that we keep having these little gap downs ever since end of April. That was my little chart I was gonna show. It's all good. Anyways, you see these gap downs on QQQ. You see little retest towards the tops. We haven't seen any true confirmation. So I'm waiting for that confirmation or that gap to confirm itself. If I see a huge gap or something just take off and run, I'll let it go. If it's because of an earnings, I have a 3-day in rule, just like a lot of people do. Meaning, if I see a huge gap up on a stock and I'm not already in it, I'll let that sucker go. Wait a couple days, wait for that to settle off and settle in, and then I'll take advantage of it. But as far as chasing the big moves overnight or the gap, I already have my level set and my play set to where I'm playing ball. And, I may use some intraday trades to really capitalize on maybe a big move, but the overall picture is something that I really like to focus on. And as we start breaking down through those levels, I'll just continue walking the dog down. That being said, if I do see volume continue in a certain direction, that's where I'll take a scalp on that. But other than that, I just let it roll.
I just want to point out one thing before I answer this question. We talked a lot about previous supports or resistances, in this case becoming new supports. previous resistance, right? Previous resistance then acted as support. Buyers then bought the indice all the way up. And then once you return to that level, what do you find? Buyers step in. Buyers step in, fail. Sellers push it back up. Buyers push it back up. Sellers push it back down, push it back up. And then we just teeter-totter on this line right here. Lots of support in this level. So very interesting to see. You can, like I said, you can literally just pick through these charts and find it everywhere. It's very, very, very in your face.
Draw a line at 268, Zach. Draw a line at 268 and draw a line at 251. Or 268 and 252.
Horizontal line. 250. 268.
268.
We're just gonna do averages here. I'm not gonna
do it about. It's done it, and then 252.
252.
These are my boxes. Yeah, 252.
It's big.
Yep. These are my boxes. Obviously, I'll have one line right in the middle of that. But that being said, this is where I'm looking for downside on the Qs to actually kind of form a bottom here, or my next range pretty much. I thought we were going to hold at 290 where he's got that line. I knew it was coming out at 280 after that. If we fall out, if you look back here where this consolidation is, move your mouse just a little to the left, Zach. Right there, then keep coming down. You saw a little more consolidation back here. These are the levels where buyers and sellers couldn't make up their mind. That little consolidation happened before that push. So I'm looking at these previous levels where they kind of played ping pong to draw my ranges, and that's how I'm looking going forward. If we're looking at, people say a bear market rally, 330 all day long. You got to get back to 330 before I'll even play ball further going on that way. We don't get past that. 300 was a big psych level. But 330 is where we have to cross for this to end the day. Other than that, we're just going to continue trailing down until they stop screaming on CNBC.
Yeah, on day 3 as well, we're going to leave you off with a couple different concepts that you guys can study deeper, and more market structure concept. They're really more complex. All these concepts that we're about to go over support. Let's break it down like this. You have the most simplest, most basic, very easy to understand support, resistance, And then if you take it one step further, you have supply and demand. They're telling you the same thing, but it's just a little bit deeper in the concept. And then you get to super complex and you understand market structure. And what is a minor break of structure? What is a major break of structure? What is a change of character? What is liquidity? And what is order blocks? Or what are order blocks, I should say. And so those are really deep concepts and they're pretty hard to grasp. I'm not going to lie, they're pretty hard to grasp. I haven't fully grasped the whole entire concept of it. It gets very deep. That's what the institutions are looking at. But all these concepts, you start at support and resistance, and then you just go one step deeper and then one step deeper and one step deeper. And you really get to build upon itself and really build a good foundation for what you're actually looking for technically. But somebody asked a question, how can I trade with limited funds? So I actually just had a one-on-one with somebody that's in the group that has limited funds. And one thing, we're going to go over a couple of things. One is you have to have a very strict rule base, during your rules that you're setting, which will go a little bit more in depth on day 2 tomorrow on how to set your rules. But you want to set a stop loss rule and you have to stick to that stop loss because you're dealing with small funds. So you can't be taking on large positions and then sitting there in a position that's just depleting your funds. So you have to have a really tight stop loss rule and just apply to it. Not apply to it. Just make sure you take action on it every single time.
Also, trading stocks that are in your wheelhouse. Sorry, I don't mean to interrupt, but really important.
One rule that's really, really important is that when you have your price targets, say that your price target is your resistance on the day. As a small account, you don't need to hit that price target to take your profit. What you need to focus on is consistency. You have to get that $30 on the day. That's $60 on the day. Or maybe it's $15 on the day, $20 on the day. But you have to build the account every single day, $20, $20, $20, $20. On 10 days, you'll have $200 more. And then say after that 10 days, you might then start making $30 a day. And then 10 days later, you're going to have 300 extra in your account. But the point being here is that you're not looking for the home run. You're not looking for the full trade. You're looking to be profitable on the day and be consistently profitable, because any losses that you take is going to be a big hit on your account. And then adhering to that stop loss rule, you want to make sure that you are not taking that big loss. So you might have that $20 day, the $20 day, and then you adhere to your stop loss on the third day. Say you take an L, but it's only maybe 10, 15 bucks. You're still $25 or $30 up over the past 3 days. So you're still green over the past 3 days. So for a small account with limited funds, you have to make sure that you are not getting greedy. You're not looking for the home run that's going to take you from $1,000 to $3,000 or from $500 to $1,000. You're looking for the trades that are consistently making you $20 a day, $30, $50, $60, and you just build and build and build and build and just do that for 30, 60 days. And at the end of it, if you started with $500 and you made $20 and then every 10 days you upped it by $10, you might at the end with like after 60 days, $3,000. And then after that 60 days, maybe start taking bigger positions or looking for a lot fuller of a move and then up yourself to the point where, okay, now I'm making $100 on the day. And then you'll get to the point where you make $200 on the day and you just slowly grow. But it's really, really important to be consistent on a small account because going for those home runs is just, one, it's super stressful because after time, you're going to have so much, you're going to have this emotional tear of just pushing you up and pulling you back down, pushing you up, pulling you back down. You're going to get really exhausted. And it's going to be awesome when you hit a home run. Don't get me wrong, but it's going to be really, really terrible when you strike out. And you're going to strike out way more times than you're actually going to hit that home run. And we do break it down a little bit, what it's like to have an account. And if you're taking too big a position size, what it looks like if you take a big hit on that account, what the actual percentage it takes to get back to break even. As you take bigger percentage of your portfolio in single positions, and then you therefore potentially take bigger losses, it takes a lot more than you would think to get back to that break even point because you're starting with a lower base of capital. So hopefully that adds a little insight into that.
I'm going to add on to that. You also want to trade stocks that are in your wheelhouse, meaning that it's not always, well, for example, new account, small account, you should not touch Tesla. Tesla contracts, highly volatile, highly liquid, move really fast. And as a small account, you would have to move way outside the money. Not something you should look at. You should look at companies with the beta that makes sense to your account and the length that you're able to risk come back to your size. Because as a small account, like he said, you're only building it in. So you obviously want to manage that risk management and follow plays that make sense for your account. There's plenty of plays out there, but there's also stocks that on a small account or trading smaller funds that could just tear you up in a second. Like an AMD, those plays move ridiculous. You have to really manage that stop. You have to watch these stocks that move with crazy volatility, like a Square. A Square contract could make sense in your portfolio, but they move with extreme volume and volatility. You could get blown out real quick. So that being said, just manage your plays, watch the stocks that make sense for you. And then as you get going, you'll be able to open up those kind of opportunities. Something I tell people a lot with is using house money. That being said, is to start building up with your risk management and your profit taking. When you learn this, is that you love, like I said with my earnings example, I love using house money. I love day trading and then having that risk tolerance to be able to use what I grew in that day towards a riskier trade. As a small account, you kind of got to grow and you kind of build, but as you continue to stack those coins, it'll eventually give you that opportunity where you built up your account up enough to where you can take $50 of it and put it to a play, put it to a swing that can open your account up even further. But day gains definitely the focus.
We're going to have one last person, Dr. Nay, if you'd like to speak a little bit about having a small account to where you've come now, being with us for 6 months or so now, or 4 months, 6 months. You and Mr. Polanco, Dr. Polanco, I should say. You guys are the doctors of the group. Anyway, Dr. Nay, go ahead and say what you wanted to say.
Yeah, well,
small account.
I just wanted to enlighten what you were talking about, trying to make a small profit. It's easier when you have a small account to get a $30, $20 profit. And in sometimes what I was doing the mistake before is that I was being greedy. Oh, I made 20. Let me see if it goes to 30. Ooh, it went to 40. And when I realized the thing just dropped to negative, instead of me just coming and taking my $30 or my $20 and be happy that I was green, now I am on red, and I end up losing sometime my entire contract. And I said, what the hell? I'm just going to let it expire because I lost everything already there. And the way that you are saying it, I was able to build up my account, and I double it this week from a 600 to a 1200, and today I closed it up at 1600. So, it's the way the system that you were talking before, it works. It really do work. As a matter of fact, I play Facebook, and I made 97 cents, and I was happy. I was 97 cents green.
Yes,
I
sir.
didn't lose any money, but those 97 cents add up to that $1 that I had before. So people gotta listen to you, and just don't think that you're gonna hit a home run. No, just take whatever money you get there and just get out. And if you see a moving keep going on, just get again. That's it. Thank you for letting me share my story.
Yes, sir. Thank you for sharing your
Always,
story. That's it's good to hit home on that. With that being said, we are going to end it here. It has been about 2 hours. I'm glad that you guys are asking questions. That's really, really, really awesome. We want you guys to feel comfortable in this space to ask questions. Like we were saying, no question is big or small enough to ask. Just ask the question. We're all family here. If you don't want to ask it in front of everybody, that's totally fine. I do understand it. Just message us. Just message me personally. And here I can see it, right? I can see a direct message. Just message, keep it anonymous, etc. But the questions, this is an amazing time to ask questions. This is completely free. You have the full opportunity to write in the chat or come off of mute and ask us questions. Please utilize that, especially as we get into deeper, more complex concepts. Tomorrow, we're going to go into a little bit deeper of what we talked about today. We're going to go into options as a whole. It's going to get complex for a little bit, and then we're going to talk more about market structure. And then day 3, we're actually going to get to the meat and potatoes of it. So make sure that you guys understand this stuff at the ground level a little bit more, so that when it gets to day 3, when we're talking all complex and saying these words and these words and these words, you understand and you have a good understanding of what that is. On that note as well, we have a starter kit on our website. You can see it right here in our ebooks tab. You go to the starter kit, bring this up, take a look at it. It's free for everybody. If you joined into the May Options Course Discord link, you saw that an automated message came out and said to download, take a look at the starter kit bundle. It's very quick to read. It's going to give you a how to understand options, a dictionary. So you're going to have real terms for stocks, and then you're also going to have some Spencer and Zach terms in there as well that we use in the group. But it's very important to understand the terminology that you're going to be hearing us say, because you might hear us say one word, be like, what the heck is this guy talking about? It's going to be in there. So just take a look at that. It's about 5 pages or 8 pages or something of terminology. Very, very simple. We also have a morning guide to understand Discord. If you're not familiar with Discord or you've never used Discord, whatever you're going to use Discord for, it'll show you what to use Discord for. And then also there is the timeframes, which we will also break down tomorrow. But if you want to get a head start, take a look at that timeframes page as well. So again, that's free. You can just go to our website, iTrendzTrading.com, click our ebooks tab, and then navigate to the starter kit bundle right here. So please feel free to check that out. Totally free again. If you already got it and went through it, awesome. That's very good. We did record this session, of course, so that will be uploaded after all the sessions are done. We will begin to upload the videos for people to go back. If it's possible, I will upload it tonight. That's if it's possible. I don't know how quick it's going to process and et cetera, et cetera. So I don't want to promise it. However, if you guys are not already, I'm going to send the link to our Discord that we set up for this. We set up specifically for this. So it's just the students in here. You're not going to see other people talking. You're not going to see anything else. It's just the students in here. You'll be able to get access to Spencer and myself in here. And please feel free to use the main chat in here. We don't have a lot of people talking in here, although that was a little saddening here. Hold on. I got to move all these things before I get the dang thing. There we go. Hold on. So I'm going to send the link here, and then we will post the link to the YouTube video inside of this Discord so everybody can get access to it. Let's get a link in here. I'm going to post this in the chat. Hopefully this comes through easy for you guys. Discord. So go ahead and join that Discord. You'll see it in there. Once you pop up, you'll see the start here, the main chat, etc. We'll put the links to the videos inside of there. Like I said, after we get on this call, it's going to process and we'll put it up for upload. Hopefully it'll be up by the morning. If not, at the very least, it'll be up by the third day on the evening. So Mike, answer to your question. No worries if you missed some of the content. Replay will be posted online. Yes, on our YouTube, available to everybody. We'll send the link when it is uploaded. With that being said, last take for questions here. Let's see. Hopefully, can anybody write in and see if the Discord link work? It hopefully should work. I just want to make sure that it actually does work. Link worked. Okay, great. So feel free. Like I said, you'll see us in the top right corner. Zach Debo. The stale ham sandwich is Spencer. You can see it's his photo there. It's also his name on Zoom here. That's us two. You also have the other two analysts in there if you had any questions and wanted to reach out to them.
I did want to add one more thing. Zach and I and iTrendz, something about our community that sets us apart from other Discords, other channels you may join. We really focus on each person in there and getting you up to speed and making sure you understand the concepts, because these concepts are around. You can get information from anywhere, but something Zach and I pride ourselves is just getting people interested, getting people, into options, into stocks, really willing to learn, willing to put in the time. And then after that, just growing the craft. Like I said, Zach's been trading for way too long, myself as well. I've been over 12 years doing this. I'm very successful at doing it. And this is my way to give back. All I want to do is help people. All I want is for people to understand this, because trading till recently, till retail actually stepped in, was one of those things where it was like, oh, I'll go to a broker and give him money and then they'll figure it out. Now that the ease of access is opened up, I just want to teach everybody the concepts and give you something that you can carry forward, something that you can start building, you can start growing, and eventually push down the line. So like he said, it's a safe space. Reach out to us. If you're scared, hit me on Discord, hit me anywhere. Same thing with Zach. It's okay. Like, it's a safe space. Nothing's a dumb question. All I want to do is help you guys, and that's what we're really here to do. So that's all I had to say.
With that being said, we're going to stop everything here. Have a good night. And also for all the people that are here, just want to shout you guys out that you guys are taking the time on a Friday night when a lot of people are at the clubs, getting lit right now, whatever. That's fun and everything. But you guys are taking the time out of your day and out of your night to actually learn and get better at this craft, and so you guys can further your success as a trader and become a successful trader. So that really shows the discipline and diligence that you guys are putting into actually becoming that successful trader. So I guarantee you, if you continue to put this same level of discipline and effort into trading, you will get there. It might take some time. Like, trading is not easy. We're not trying to say that trading easy. Absolutely not. It took me about a year for me to really get a good grip on things. And then it took me about another 6 months to really kind of further develop my own trading style and be figured out, like be like, oh yeah, okay, so this is what I do like to trade. This is what I don't like to trade. It does really take time to master this craft. And it's an ongoing journey. It's never, you're never gonna get to a level where you've reached a peak. It's just constantly growing. It's a journey. Your consistency and discipline is really what's going to make you survive in the world of trading. So anyway, with that being said, we're really, really appreciative that you guys all came tonight. We hope to see you in day 2 and day 3. The recording will hopefully be up very soon. We'll put a link in the Discord when it does go up. And yeah, so we hope to see you guys. And that's been it for iTrendz and Zach and Spencer here. We will see you guys tomorrow at 8 p.m.